So on Tuesday, Tesla announced that it was going to split its extremely expensive shares in a 5-for-1 exchange. I think the move was pretty much designed to make the stock less expensive for individual investors after the company became pretty much the world's most valuable automaker, electric car automaker. So each stockholder of record on August 21st will receive a dividend of 4 additional shares of common stock for each one that they own. As I mentioned in the other video I talked about, because you know Apple's coming up with their split, I think towards the end of this month, August. The act of splitting the stock does not actually reduce the company's market capitalization whatsoever. It merely just increases the amount of shares available for trading, and the price is adjusted accordingly. So for example, let's say, I always use the same example, Mike's Burgers. Let's say Mike's Burgers has a stock and their stock is worth $100. And they decide to do a 2-for-1 stock split. Each stock becomes 2 shares. So instead of 1 share being $100, it'll take 2 shares to equal $100. So each share goes down to $50. So with Tesla, it'll take 5 shares to equal the current market value of 1 share. So I believe that the current market value for 1 share of Tesla stock is somewhere around $1,600. Somewhere around $1,600. So if we divide $1,600 by 5, you'll get the new price per share. So this means that after Tesla does their split, each share should be roughly around $300 and something, which is still expensive, $300 for 1 share of a stock, but it's way more affordable than this current price, $1,600, which is, again, like I talked about in the Apple video, some people's mortgage, or I mean, this is some people's all their bills they have to pay for the month. So I think that $300 down from $1,600 is way better. And overall, I think that this is good because stocks are getting really expensive. All of the stocks that a lot of younger people want to invest in, like Google, Tesla, Apple, all these stocks are extremely expensive. And so when you get these prices down, I anticipate that a lot of younger people are going to start investing in these companies, probably via Robinhood. I like Tesla. I like what they're doing. I believe that electric cars are the future. I think they're better for the environment. But personally, I'm not a Tesla fan in terms of the company. I believe that the stock is vastly overpriced. They have a lot of debt. I just don't see the allure of investing in the company from a financial perspective. As a value investor, I typically seek to invest in companies that I feel like are undervalued. And so I look for companies that are trading close to their book value. I look for companies that have a low PE ratio. Tesla has like an 800 PE ratio. Their debt to equity ratio is high for me. What else? I don't really see the company making a huge profit right now. That gross margin is also too low for me. I'm on Morningstar right now just looking at their key ratios. And it's just a lot of stuff that raise red flags for me. But that doesn't mean it's not going to be a good company in the future. So, you know, some people might invest in companies because they believe they have a future. I invest in companies because I like what they have in their books right now. I try to avoid getting on a hype train, as they say, and investing in new hot companies or companies that have a lot of emotional attachment. Tesla is a very emotional company. Like the people who invest in the company love the company. They love Elon Musk. But I've noticed just from talking to them in forums and stuff like that they don't actually care about the books. They just care about the company and they like what the company's doing. They don't necessarily understand how the company makes money or if they're even making money. They just like the name brand, which is not the best way to invest. When you invest in a company, ideally you want to know exactly what's going on with it, how they make money, how much debt they have. What is that balance sheet looking like? What is that cash flow statement looking like? What is the income statement looking like? Do they have more assets than liabilities? In my opinion, their total assets should be 2 or 3 times higher than their total liabilities. And we're going to talk about this in future classes on this channel when we break down the balance sheet. Are they making a profit? What's the bottom line? You know, stuff like that. Do they have a history of their operating income rising, their net income rising? Can I go on Morningstar and look at the last 10, 15, 20 years of the company and see that They started off in the early 2000s or the 90s or the 80s or sometime way back. And from there to current times, they have a long history of rising their revenue and rising their net income and their operating income, and they make more money. Their cash flows are increasing. But most importantly, from my perspective, do they pay a dividend? Do they have a history of paying a dividend during times of economic crisis like the 2008-2009 housing crisis, or the 1999 internet bubble bust, or even during coronavirus? Are they still paying a dividend during the coronavirus? These are just some of the things that I look for. I like to invest in companies that have a long history of tangible success. But let me know what you guys think. Leave a comment below and let me know your thoughts. Do you plan on investing in Tesla before or after the split, or at all in general? Do you believe the company has a future? Let me know. Leave a comment below and let's talk about it. If you enjoyed this class, please subscribe to the channel. We post new classes weekly and all of our content is free. As it costs time, money, and energy to make great content, please consider becoming a sponsor to our channel by visiting www.patreon.com/blackstockinvestor. And if you have any questions or concerns, please leave a comment below and we'll get back to you as soon as we can. See you in the next video.